Live. How's everyone doing? Okay, today I'm going to talk about the type of taxes that you're paying as a business owner. And as I've mentioned before, that knowing the different types of taxes that you pay will not only reduce your tax rate, but it will also help you to be in compliance with other, whether it's a federal, state authorities. So this is just based on the where you're located and what you're doing in your business that may be deemed taxable. So thank you for joining today. For those of you who don't know me, my name is Veronica Brown, and I help consultants to reduce your taxes by focusing on cash flow strategies. And what I mean by that is helping them to find write-off and deductions in ways that's going to help them to keep their cash. A lot of times when it comes to tax deduction, you have to spend money to get them, right? You have to, buy that computer, contribute to this, contribute to that, the money has to go out. So what are some of those items or some of those strategies that you can implement that allows you to do two things: keep your cash and to also reduce your taxes to get the deduction? So those two are extremely, hi Sherry, thanks for joining. Those two are extremely important because as business owners, you know that cash flow is king, and there's no joke about that. You're able to be more flexible in your business when there's more cash. You're able to invest more, to scale your business, to grow, to do, be more flexible, just because of cash flow. So that's why, these tax strategies are focusing on generating cash flow instead of spending all your money. But anyways, as I mentioned, that today I want to talk about the types of taxes that business owners are paying, and you knowing the different buckets of taxes that you're paying will help you to basically, look at, where can you find, those, I think the word that, a lot of people refer to them as loopholes as far as how you reduce each bucket of taxes. Because a lot of times when people file their taxes, or when they think of taxes in a big general category, when actually you may be paying like 6 or 7 different types of taxes in your one return, and doing certain things may allow you to avoid paying 2 of those taxes and so forth. So it's just based on the type of taxes, and the different incomes that you're generating, how you're structured and everything, things like that basically drive the type of taxes you're paying. So the first type of taxes is the pretty common one, that this is the one that everyone thinks that they're all paying. Hi D, thanks for joining, is income tax. When you look at income tax in general, that's what, everyone thinks about when they talk about taxes. But when you're a business owner, not because they say, hey, you owe such and such, it doesn't mean that that's all income tax. There's a possibility that, so for instance, if you owe $10,000 this year, there's a possibility that, $5,000 of that may be income tax, and the next 5 may be some other type of taxes. So which bucket are your taxes falling in? Knowing the different buckets that your taxes are falling in, as I said, will help you to reduce or eliminate that type of tax. So when you look at income tax, this is based on your filing status. The rate that you pay is based on how much income you're making, and it's based on your filing status. The good news, single, married, head of household, or married filing separately. Those are the 4 large categories, and it's basically capped by your income. So this type of tax, you're taxed based on the bracket that your income falls in. So normally, if someone say, what's your tax rate, you don't pay a percentage on the same amount. For example, if you make $200,000, you're not going to pay 35% on that entire $200,000. What happens is you pay incrementally. So the first, $30,000 may get taxed at 10%. The second, $100,000 may get taxed at 25%, and then the next portion after that may get taxed at 20%. So when you look at the total tax you pay, you'll probably end up paying let's say 28%, because each bucket of your income get taxed at a different rate. So it's not a one size flat rate where you say, okay, my income is, you know, $200,000 and I'm gonna pay, you know, 30% of that. That's not how it works. You get taxed in different buckets of income. So you're gonna pay tax at 10% for a certain amount of income you're making. You're gonna get taxed at, you know, 15%, 20%, 21% based on, you know, how high your income is. And basically that's how, you know, people are able to move around their income so that, and use different entity structures and so forth, so that they can basically reduce which bucket they're falling in. So that's the income tax. This is a tax that if you get a refund, you get a refund because you overpaid your income tax. This is the tax where if you get a lot of credits on your return, those credits get to offset your income tax. The other type of taxes is what they call self-employment taxes. So this is based, so every business owners pay some form of self-employment taxes. The rate for 2018, I think it's 15.3%. Don't quote me on the exact percent. I think it's 15.3% for 2018. What that is your Social Security, your Medicaid taxes. So when you have a boss, when you have a job, your boss basically pays, let's see, hi Joseph, thanks for joining. Hi Deborah. Your boss pays half of your Social Security and Medicare taxes. It's called FICA when you have a job. When you have a business, it's called self-employment taxes. So when you have a job, your boss pays half and you pay half. So you really don't, you know, a lot of people don't notice this, that, you know, they may be paying, you know, 7.5% of, you know, of the first, you know, 127,000 that they're making in FICA taxes. But when you're a business owner, you're the boss, you're the employee, so you have to pay the total 15.3%. So that's the second type of taxes. This tax, you get to avoid, you get to reduce your self-employment tax based on, you know, how you're paying yourself. So basically how you're pulling income out of the business. You get to reduce it by changing your entity elections, and also looking at how you pull out salary versus distribution out of your business. And I think I already said the which entity you're taxed under. So those are the things that affects, you know, if you're able to reduce your self-employment tax. So those are, so a lot of times for business owners, those are the two big categories of taxes. There's a next category that's called alternative minimum tax. There was a big conversation about this back last year when the new tax, before the new tax law got approved, that, you know, everyone wanted them to get rid of, you know, the alternative minimum tax, because it was basically a tax, you know, back in the old days where, you know, they were trying to get a lot of high income earners to basically pay their fair share. So, but what's happening now that is affecting a lot of business owners especially, and a lot of, you know, you don't have to be making $1 million to get hit with alternative minimum tax. So it's not, the income level that it's being applied to now is not as high as possible. So basically what this tax does is basically eliminate some of the deductions that you're entitled to, and say, just because you make, you know, this amount of income, then we're going to reduce these write-offs that you get, and you're going to have to pay this tax at this higher rate. So knowing those different items, you know, that you can work around in order to avoid the alternative minimum tax. So those are the taxes that are from the federal government side. And you know, there's, you know, investment income tax. You know, if you have a lot of investment income, then you can get tax based on your investment income, but that rate is pretty low. And then the capital gains rate is also low as well. So if you have any investments that are a year, that you hold for over a year or longer, then you get taxed at a pretty low capital gains rate. And, you know, people like that rate just because, you know, if you're a business owner and you start to, you know, invest money, you know, with your financial planner and so forth, and that's one way for you to be able to diversify your income and also reduce your tax rate just because you're getting taxed at a really low capital gains rate. So that's where you can put some of the extra cash that you may have in your business to be able to put in some investments where you can generate capital gains, which get taxed at a much lower rate than what your active income is being taxed at. The other few that I'm going to share with you today, one is sales tax. So this is when you have to collect the money on behalf. So you basically don't pay this out of pocket. Your clients and customers pay this. So, you know, even if you're a consultant right now, and if you're selling things online, you're selling PDF downloads, you're selling subscription to your courses, you're selling online courses and so forth, based on the state you're located in, you may have to be collecting sales tax. So check with your state. Sales tax is paid to your state. So check with your state, and based on the county that you're located in, then it will determine if those items will trigger state tax. There are some states that tax services. Not a lot of them do, but there's some state that tax services that if you're a service provider, which consultants fall under that general category, that, you know, they may want you to add taxes to your invoices. So those are some of the things that you have to check on before it's too late, because once the sales tax authorities come around, and I can tell you they're way more aggressive than the IRS, that, you know, they'll be able to basically what they're going to do is just look at your bank statements to see how much income you have generated and try to apply a sales tax. So if you didn't collect the money, then you're going to have to pay it for yourself. And the weird thing about sales taxes, in most states, you are personally liable for it. So even though you have a business and you register it, get your sales tax ID in your business name, in most states, you are personally liable for every penny of sales taxes. So that's what makes it a little weird, because you can't really shelter it under, you know, limited liability protection. So if your business defaults, you still have to pay your state taxes. Hey, Anne Marie, thanks for joining. Marsha, what's up? How are you? But anyway, so I did sales tax. Then for those who owns physical locations, chiropractors, medical offices, people who owns physical locations, if you're an attorney and you have an office, then that's where personal property tax comes in. So here's a joke with this one. If you buy a piece of furniture, then you may have paid sales tax when you purchase it from the furniture store, right? But what your county that you lives in, they also want a piece of that. So they tax you on the personal property that's located in your place of business. So if you're a medical office and you have a lot of medical equipment, you have office furniture and things like that, they come in and assess the taxes on those items. Yes, it's gonna be a pretty, it's not as much as any other taxes. They give you a discount rate based on depreciation. So it's pretty low, but that's one taxes to look out for. And those are for people who owns, that has physical location, that there's a personal property taxes. In some counties, the tax agents come around and they may visit your office. For people who works at home, they don't have that problem. No one is going to come visit your home office. But for those who have physical location, they can come around and check out what's going on at your physical location. So you're more at risk than anyone else. And as I said, it's pretty discounted based on, depreciation and the life of, your equipment and the furniture that you have in your office space. So whether you rent an office space, own the place, lease the place, it doesn't matter, as long as you have equipment, office furniture, and so forth, then you pretty much get into the category. You pretty much will be liable for the business, personal, property taxes. The last one that I'm going to mention is the occupational tax. And this is the one that, this is a county tax as well. So based on the county that you're located in, it's just basically saying that, you know, you're a professional or you're operating this business, you know, you pay X amount based on your gross revenue, or you can pay it based on the number of professionals. And this normally goes with your business license. So when you go ahead and tell the county that, you know, hey, I'm operating business in your county, then that's how they're able to flag you. And you have to fill out that, you know, occupational tax thing. I know, you know, here in Georgia, it's like $400 or $300 per professional. So some of those taxes, like your sales taxes, your occupational tax, and your property taxes, there's not a lot you can do to get around them. Property tax and the occupational tax, those are pretty small amounts. The sales taxes, you should collect it from your customers. So if you're starting to sell a lot of online products, subscription to your online programs, PDF downloads, courses downloads, any of those things, that you should check with your state that you're living in to see if those things are taxable. And if they're taxable, then you start putting the tax amount on the invoice that your customers are paying. Apply for your sales tax ID and remit that amount to them. On the other type of taxes, the capital gains taxes, you get that by by generating investment income. So if you have a lot of cash, then, you know, you can, you know, talk to your financial planner or whomever is your investment ID advisor, and they can help you to be able to start generating some capital gains income. So those, and, you know, that will, you know, help you to pay taxes at a lower rate, plus also growing your portfolio and how much investments that you have. You know, income tax is based on your filing status, and the self-employment tax is just based on, you know, if you're self-employed, and based on the entity that you pick and how you're paying yourself, that's how you get in your self-employment taxes. But I'm getting a little hot talking about this right now. It's getting heated in here. I need to get some AC anyways. So I'll see you guys next time. Thank you for tuning in.